Welcome everyone to the very first JMI Wealth monthly video for 2024. Now I hope everyone has enjoyed summer so far. We've been really spoiled up here in the north with great weather, but I hear that the South Island has been a little more changeable. Now, financial markets never sleep, but for us, the Christmas and New Year period is always a good opportunity to reset and pause, and in our case, think about what the new year may have in store for investments and investors. Now, as it turned out, the last quarter of 2023 was a really good one for investors. Interest rates fell, share markets generally went up, so that's a positive outcome for portfolio returns. And some of the numbers for the full year of 2023 were remarkable. The global share market index rose by 21.5% over the year. The US market was even stronger, lifting 26%. And if I look at the NASDAQ 100, that's the top 100 stocks in the tech-heavy index, that gained a startling 55% over the year in US dollar terms. And after a pretty extended period of lackluster returns, interest rate products, think bonds and bond funds, they finally contributed to portfolio performances in a really meaningful way with things, for instance, the New Zealand corporate bond market. It returned a really healthy 7.4% over 2023. Look, unfortunately, our part of the world, though, underperformed. And last year, the NZX 50 gross index, that includes dividends, it only returned 3.5%. Now, the Australian market, it was stronger, but a 12.4% return was still quite a way behind the stellar performance of the US markets. All of the various asset classes, though, did combine to generate better portfolio returns than the previous couple of years. Now, we're recording this video in early February, so time really has flown by and we've already got a month of 2024 under our belts. And after the usual sort of Christmas and New Year hiatus and activity, markets are now humming and there's plenty going on. Now, interest rate markets took centre stage through January, with most of the central banks back into the swing on monetary policy decision making, and certainly locally in Australia and in the US, the interest rate markets have continued to sort of anticipate when the respective central banks would be able to start reversing the direction of their different policy rates. So in the local context, I'm talking about, for instance, when the RBNZ could start lowering the official cash rate. Now, the rhetoric from the banks, though, in all of these jurisdictions has been to push back against that market stance. And look, at one stage, the market was putting a 90% probability on the US Federal Reserve lowering the Fed funds rate as early as March. That probability has now fallen to 20%, and I doubt whether they will move that rate. And the interest rate markets in Australia and New Zealand have also been anticipating earlier moves from the RBNA and the RBNZ than the central bank themselves are forecasting. Now, I think the central banks will be cautious. And I think they do need to lean back against the markets. Otherwise, you'll see a fall in wholesale interest rates, and that actually starts undoing some of their monetary policy impact. The good news, though, is that inflation is falling all around the world. But there are a few similar themes that we're seeing across jurisdictions. What we call tradable inflation or imported inflation, that's fallen quite dramatically. But domestic inflation hasn't fallen as quickly. It's sticky. And in New Zealand, for instance, it's being pushed up by things like council rates and insurances. And that's an ongoing concern for the monetary policy authorities. Now, the future path of monetary policy at the moment is not that easily identified, because while inflation is moderating, economic activity is actually not slowing to the degree that had previously been feared. Now, in the US, we've been talking a lot about a soft landing. Now, that's still very much a possible outcome. And while previously the chances of the US sort of threading the needle between too much economic froth or not enough, the chance of that has seemed low, recent data has actually suggested that soft landing may just eventuate. And share markets have continued to rise, and so far 2024 has seen the bulls still in charge of the markets. Now, locally, we had concerns about a hard landing, but over the last couple of months, we've had employment data released for the fourth quarter. That was stronger than expected. Tourism, we've seen a welcome return of tourism, and we've had an uninterrupted summer of tourism, look, so far. Dairy farmers, in particular, they're likely to be welcoming the strong run of outcomes we've seen in the global dairy trade auctions, and we've seen the associated lift in the forecast farm gate milk payout. And look, in the general economy, business and consumer confidence lifted. Now, these are all positive outcomes, but they're not necessarily consistent with lower interest rates. But if inflation does continue to moderate, we would expect interest rates to be lower at the end of this year. And Australia's in a similar position to New Zealand. Now, in portfolios, we continue to favour offshore shares over local shares. So we've continued to hold an overweight position in global shares compared to what are our long-term recommended strategic asset allocation positions. And I think the role of the Magnificent Seven this year will be fascinating. Last year, they sort of led the US market higher amidst much hype around the potential for AI to bolster their offerings and their business success. But it's still early days for AI. The recent reporting season, though, has done very little to dampen investor enthusiasm. And at the time we're recording this, Microsoft is up almost 8% so far this year. Amazon is up 11%. Nvidia has stormed up 35%. Meta or Facebook's up over 25%. Google disappointed in its earnings report, but it's still up over 3% so far this year. Apple has seen its share price stall. Tesla has been the standout because it's been hit pretty hard. The share price has fallen over 25% so far this year. But Tesla aside, the year's started well for the Magnificent Seven. And now looking at income assets, at this stage, we also think that sort of balance favours owning term fixed interest assets over cash. But how the inflation story plays out this year will determine whether fixed interest can deliver another year of strong returns. So we're really looking forward to 2024, and we're looking forward to being able to assist you with your investment questions and needs this year. So really just don't hesitate to reach out and contact us. You can always look us up on jmiwealth.co.nz. We're on Facebook, we're on LinkedIn. We'd love to hear from you.